Here now, I want to call your attention. So just think about it. The funds have been outperforming in the 5-year period, but in the 10-year period, the median of the category and say the Nifty 500 have given exactly the same return. Now, what that means is that the first 5 years were not so good actually for the category, and then the next 5 years have caught up very sharply. So I think there are times when, say, the strategy does not do as well as a generic market strategy or even certain categories. Of course, you studied so many of the categories in your previous sessions, and you would observe that some of them would have done more than this over even a 5-year or a 10-year period. But at the core, right? So, what is a dividend yield company, right? So, it's one where you're getting dividends from the underlying stocks, which are high, right? So, and you may ask me in the context of equity investing, where everyone's investing end of the day to make like big capital gains, right? I think that is the way that investors think of equity investing. But history has shown, and studies over very long periods in developed markets have shown that dividends are not a trivial component of total return. And dividend yield has actually been a pretty decent kind of indicator or way to really pick stocks in different markets. So in general, fund managers in this category like to look at not just stocks which are paying high dividend yields, but they want to also look at two more parameters, that the dividends should be firstly sustainable, right? And I think this is important because there's a famous analogy called a dividend trap. Now, the problem in a dividend trap is where you have a company paying, let's say, suppose it's 100 rupees stock which you're buying in the market, and is paying a dividend of maybe 10 or 15 rupees. But that is not sustainable. There is something extraordinary happening. Either it's just a one-time dividend, for example. Sometimes companies which have extraordinary gains, maybe if they sell off a subsidiary, make a lot of money on that, they might give a one-time dividend, but that is not something that you're going to keep getting. So, a fund manager in a dividend yield fund would tend to underplay that aspect and not give such a high weightage to an unsustainable dividend. The other one could be where a company's business is today throwing cash, but may actually get disrupted over time. And we've seen that that there tends to be mortality in companies, or certain existing lines of business may fall out of favor due to changing market trends, or there could be n number of factors, including regulatory, ESG, market practices changing, etc., which may lead to that high dividend not being sustainable. So that's where you don't want to step into that dividend trap, and you really want to find the companies where dividends are sustainable. And second is, ideally the dividend should grow as well over time. Because end of the day, what are we in equity investments for? It's really for growth, right? How is the category done over time? So I would say, looking at, say, the 5-year kind of track record out here, say the median fund in the category has given a CAGR of about 21%, which has beaten the Nifty 500 index out here. Here now, I want to call your attention. So just think about it. The funds have been outperforming in the 5-year period, but in the 10-year period, the median of the category and say the Nifty 500 have given exactly the same return. Now, what that means is that the first 5 years were not so good actually for the category, and then the next 5 years have caught up very sharply. So I think there are times when, say, the strategy does not do as well as a generic market strategy or even certain categories. Of course, you studied so many of the categories in your previous sessions, and you would observe that some of them would have done more than this over even a 5-year or a 10-year period, which makes it kind of important to look at these returns. Where are we in terms of the context of timing as well? Contrarily, its most simple definition is to look at stocks and sectors that are out of favor. So I think that's very easy to kind of identify, right? Each of us intuitively also tracking markets knows that today, okay, till a few months ago, I think IT, we know IT is not doing well. We know financial services, large cap banks, for example, have been a little out of favor. We know the stocks that are in favor as well. So, till the end of last month, we saw that actually stocks leverage to the capex theme, whether in like capital goods, industrials, real estate, etc. They were doing very well. And now the job of the Contra fund is to one is try to find those sectors which are out of favor. So I think a good example would have been, say, in 2018-19, to go out there and identify, say, infrastructure, capital goods as a kind of good contra theme, where you say that here's a sector which India's got quite a few decent companies within that space, long track records. Some of them have survived several cycles. Uh, and it's just that this sector is out of favor because the business cycle is against it, and that is something which can come back over the next 5 years or so. And there, that's one way to kind of identify those contrarian ideas. For fund managers, I can tell you personally, because we love to spend time kind of individually looking at stocks, right? Not just broader sector or market themes. So we love to find names which are within a certain sector. So that could be a sector which has done well. It could be a sector which has done poorly. You find that one company or a couple of stocks which have the ability to break out of that sector's constraints, and really kind of on their own individual merit. Either it's a certain sub cycle within that sector. So suppose you're if I talk in the auto space, for example, if let's say at a certain point in time commercial vehicle is doing relatively less well than other spaces within the automotive sector, you could find it, okay, I'm going to find a couple of commercial vehicle stocks and say that now I'm going to buy them because the market is not really focused on them, but I do believe they'll come back. Alternatively, it could be self-help. So there could be a company in the auto sector, for example, which has, say, significant challenges which it is facing in certain parts of its business. Maybe in the current context, I mean, this is not an actual company I'm talking about, just as an example. Say if a company does not have a strong EV portfolio, which today the market is kind of valuing those with a premium, but you can say that I think that okay, they will find a way, they will come with a strong EV offering because of certain work that I've done. You might want to take a view that okay, that's a great contra idea, and let me go and add that security. Now, due to the fact that you're looking at sectors when they're out of favor, generally there is a value bias for these contra funds with the portfolio aggregate PE or other portfolio valuations being lower than market averages. Similar to how I mentioned about, say, buying stocks in the value space, here again you're looking at what is trading below what you think is the fair value or intrinsic value for that security. Now, whether you find that based on current, say, P ratios, PB ratios, or you're doing a discounted cash flow analysis to what you think the company's future potential is, these are all ways which fund managers will use effectively to identify these companies. And really, you love companies which have strong fundamentals, but today there is some temporary, performance issue, and this happens in all kind of caps, right? You see that in several large caps, you have these periods where there is a certain very high quality company which falls out of favor of the market due to some aspect which is seen as very pressing at that point in time. But it's possible that overall circumstance itself changes, or the company is able to change to kind of really catch up and do well over the longer term. Now, like I mentioned, that fund managers typically will have a combination of stocks in their portfolios, which some which would have not yet done well, but we are expecting that they are likely to do well. And there would be some companies which we have correctly identified in the past, let's say 3 years ago, which have now done well. So, one can maybe an investor can ask that, okay, today, let's say infrastructure or real estate is not really contrarian, but a contra fund manager is having that still in the portfolio. So I think it boils down to, you need to look at when really did they get into that theme. If it's a portfolio manager who's now buying it, who didn't have it over the last 3 or 5 years, you want to question, okay, are they really true to the philosophy? Whereas if it's someone who's had it for the last 3 5 years before it started doing well, it's something where you want to say, okay, here is a portfolio manager who's able to identify it.
If we're talking about Contra, जैसे आपने बताया कि कॉन्ट्रा में द फंड मैनेजर का व्यू इज टू बाय समथिंग विच इज नॉट इन फेवर. तो आज कुछ स्टॉक है या सेक्टर है जो फेवर में नहीं है, आज बाय कर लिया. आफ्टर सम टाइम द साइकिल वुड टर्न एंड those sectors or stocks would become in favor, right? And then probably fund manager will have to look at something else. So as a result of this, is it a pattern where a contra fund would generally have a higher churn as compared to any other diversified fund?
Not necessarily so, because some of these opportunities may take time to play out. So, in the same example, suppose, say, infrastructure, if one could have taken a view in 2019 that, okay, it's looking interesting now, I think let's get into it. You really didn't see the full extent of the return benefit till 2023, right? So, I think it was then that you started really seeing the huge benefit. So, I think depending on how much the fund manager judges that the theme has played out, you can have a mid to longish horizon on individual names or sectors as well. Having said that, if say something rallies immediately, if you are able to identify something, maybe if you're very lucky, and this doesn't happen very often, that you identify something just before it runs. But if you are lucky enough to do that, then potentially yes, in that small part of the portfolio there could be higher churn. But I would think overall may not necessarily lead to higher churn from the portfolio.